India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, hi, good morning.
Hi, good morning, folks. And hi, good morning, Nigel. It's a new look. I think we're taking a bit of a different approach today.
Nah, I mean, just adapting to Mumbai winter, so to call it. Unfortunately, I don't get to anchor from Delhi. Otherwise, I could have worn it more often. But yeah, it's part of the New Year, Christmas look. Yeah. Once, twice a year, we get the green signal. Might as well go for it.
We enjoy our little winter, whatever it is, 2-3 weeks.
This time of the year, I mean, Delhiites are out with their coats and
mufflers,
scarves and their
the boots.
Yeah.
It's stylish. So I think we're bringing some of that here.
Good. Well done.
All right.
But otherwise, for the market, I mean, it's. I guess now we have Wall Street also slightly iffy, but then I mean, we've had our own issues for a long time.
Yeah, the good thing is that the market here is already sort of compressed quite a bit. A fair bit of selling has happened. So that's the hope, right? I mean, the damage is, a lot of damage here has happened, which of course has not been the case, especially in the US, which of course is on a different planet pretty much. But let's start with the basics in terms of what you need to know as we begin this session. The fear last night, and I'll get to the prices and the price action in a bit, but the fear essentially was that the Fed essentially is going to be a little on hold for a little longer on the back of stronger economic data. Now, the data I will refer to in just a bit, but the price action, S&P was down about 1.25%. NASDAQ was down almost about 2% or so. Rates market, the 10-year was up 6 basis points. We are back to about 4.7%. The dollar index, which had cooled off a little bit, it's still not at the highs. That was past 109 levels. We're at 108.7, but was up 0.4% or so last night. Oil prices at about 77. They're up about 1% or so. Now, the data points, right? So you had the ISM Services Index, which has reached the highest level since 2023. Services is the sticky part of the economy. It's the larger part of the economy, pretty much across the board in the developed world. And that is sort of firing. That is looking good. JOLTS, that is the job openings in the US, that also beat expectations, consensus expectations in a decent way. So these are essentially two things at the margin, new things, which the market kind of read into and said maybe the Fed, the first sort of cut, first of all, by the way, in 2025 now, the expectation is 2 cuts in 2025 from the Fed. And will the first cut of 2025 only be in somewhere in June or July? It's possible. And market pricing is moving like that. And that's the reason why you saw the reaction in rates and consequently, equities coming off as well. By the way, it was a bit of a rough session for AI stocks as well. There was all that excitement about NVIDIA and the CES, the big conference, Jensen Huang, the NVIDIA chief, making that keynote address. NVIDIA ended down about 6.5% last night. Now, Trump, the incoming US president, gave a press conference. It emphasized tariffs on Mexico and Canada. We will play out sound bites on that. It was, as always, fire and fury from Mr. Trump. To me, it was not what he said, because what he said was, it was a repeat of what he said before. It was what he did not say. The one thing he did not touch upon was China tariffs. We're not reading too much into it, but there was no mention. He talked about tariffs with regards to Mexico, Canada, but nothing about China. Now, just to sort of come back to the levels here and how we've left off. So yesterday we had a good session with the bounce that we saw, much needed. The broader market did even better. So it's back to tracking day-on-day price action. Hourly averages for the Nifty, as you track, if the recovery has got to sustain, it's got to take out hourly and then daily averages. The hourly averages converge around the 23,815 level. Yesterday at the day's high, we were just short of the 23,800 level. So that's the first cluster of resistance. And then, of course, you've got the short-term daily moving average, which is 24,045. These are all very near-term compared to where we left off yesterday. On the downside, a break below 23,551 will tell us that the structure is weakening further. So you got to take it bit by bit. The Nifty Bank, similarly, I'll start with on the way up. Again, a decent day. Better than the Nifty, by the way. Resistance at the 20 hourly average, which is 50,460. and then the 40 hourly exponential moving average, which is 50,690 or so. And of course, on the way down, 49,751 is the level which the Bank Nifty should not break. Again, very near term, but as I said, it's got to be day on day as we track the recovery or further weakening here. So that's essentially the setup. GIFT Nifty will come up on your screen. A quick look at what the start is indicative of, about 30 odd points lower. Surabhi.
Okay, well, absolutely. And the Asian markets have kind of taken over that week handover from Wall Street and this big tech sell-off that we had. And most of them are now flashing red. There's more red than green on the Asian screens, including big markets like Hong Kong, Nikkei, etc. In terms of additional news flow out of Asia, mainly two big talking points. One is inflation in Australia, which is accelerating. The second is Samsung, which is a very, very large MNC. Their profit forecast for the fourth quarter isn't all that great. The market's not too enthused, but those shares are holding up in South Korean trading for what it's worth, at least right now. So that's the overall picture. The markets across Asia are also tracking exactly the very same thing, the move on the dollar. The dollar index is still below 109, but that acceleration that we've seen in the last 12 to 24 hours, that's something that's being watched very, very carefully, as well as, of course, the further moves in the yields. Now, let's come to cues over here. Yesterday, at 4 o'clock, we had the first advanced estimates of GDP coming through, and that has been a talking point. Now, for the market, it's not really a shocker. Because the number is very, very much along expected lines. What we're saying is now 6.4%. It's a sharp deceleration from last year's numbers of 8.2%. But for the market, like I'm saying, it's not new. However, when you see the numbers, it kind of just drives home that same point. Actually, the estimates for agriculture are much better. In terms of overall GDP, agriculture is much better than manufacturing, because look at the manufacturing number. It's 5.3%. That's the growth estimate for this year compared to manufacturing touching almost 10% last year. So that dip is sharp, and that's why we've seen the slowdown in earnings and therefore the market as well. We'll have more cues on this. Lata will talk us through some of the other salient features. Remember, it's all about an expected pickup in government spending in the second half, whether that's going to happen or not. Gross fixed capital formation is being projected at about 6.4%. More on this in just a bit. Now let's come on to the fund flow picture. Not too much to sort of, speak about over here, but the fact is that FIIs were again on the sell side. We've just gotten so used to that, 1,500 crores of selling coming in. It was absolutely offset by the domestic buying yesterday, so that was good. But what seems to be very clear that the kind of capitulation that we saw on Monday, which was perhaps HNI or direct retail stocks, stock players, that probably is out of the system. So the institutional flows are offsetting each other. Finally, in terms of a sector to watch today, maybe today and over the next couple of days, I'm going to keep a spotlight on the auto names, specifically the PV manufacturers. Yesterday, Mahindra & Mahindra announced the pricing for their electric vehicles, the ones with the larger battery packs, the 79 kilowatt hour. And there, the BE6 is priced at almost 27 lakhs. The XEV9E, now that's priced at 30.5 lakhs. Why am I watching for this? Because if these models start getting sort of adopted well in the market, and I think they're promising delivery starting Valentine's Day, look at the price tags and imagine what this can do to the margin profile for a company like Mahindra & Mahindra. Very, very critical as we go forward. And finally, even Maruti. Watch for Maruti, not just today, but the coming couple of days. Maruti is now talking about its own EV ambitions. Yesterday, it revealed the identity. The entire blueprint is called E for Me, and more details and the launches, and they're talking about setting up the entire EV ecosystem. All that will be announced during the Auto Expo, which will take place later in January. So auto definitely in focus for me today and over the next couple of days. But Nigel, what are you watching for?
Well, that's right. The global queue is actually a little bit iffy because you don't know what US President Trump is going to do when he takes over office on the 20th of January. And also there is that uncertainty with regard to the Fed rate cut action. But all these three indicators on the screen, they need to consolidate a little bit, or they need to peak out a little bit. And because all of them have moved up a little bit overnight, that's a bit of a worry for the emerging markets, and India included as well. So that's about the global picture. What did the FIs do? Well, in yesterday's trading session, they added long as well as short positions in trade. And now that net short positions from around that 80 to 83% odd, it's come down to around 80%. They continue to remain net short, though, on the index with more than 2 lakh contracts on the short side. I was going through an Ambit note, and they said that, more often than not in the last few years, when FI short positions are at this level, we do end up higher in the next 6 months or thereabouts. So let's see whether or not this time as well that holds out as well, because the short positioning is at around 2.2 lakh contracts. Clients, well, they are flipped it over. They're on the opposite end of the spectrum, more than 65% of their positions on the long side, with the net long positions as well out there. But in the last couple of sessions, besides what the FIs are doing in the cash market, they have been adding some long positions as well on stock futures. And that's precisely what they did yesterday as well. So though we ended a little bit higher yesterday, on select stocks, it appears that they added longs and they covered some shorts as well. Though in the last few days, another point to notice, clients that are aggressively net long on stock futures, they have unwound some long contracts on individual stock futures. Keep in mind, clients and FIs on stock futures, both of them are net long. But clients, particularly in the last 2 to 3 sessions, they have unwound close to 45,000 long contracts on stock futures itself. So that could be one of the reasons why we're seeing some kind of pressure on select stocks. Moving to the levels that you're looking at, the 200 EMA, most important. You will get a little bit more confident from a bullish perspective once you get past this level. Otherwise, on the downside, you don't want the recent low to get broken out, which comes in at around 23,460. The Nifty Bank yesterday showed signs that it wants to fight back, but it met with resistance at around that 50,500 odd mark. So yesterday's high is important. The 200 EMA, this is an important resistance zone for the Nifty Bank, while the reference point is the recent low. The stock that I'll be tracking on from here on is Reliance Industries. 2024, big underperformer, underperformed the index by around 15%. But now Jefferies has put out a note and they're saying that valuations is the lowest we've seen all the way since COVID lows. And maybe that could be the much needed trigger, because they're saying for 2025, there are various triggers that are lined up. The recent lows around 1,200 rupees odd, you'll want it to protect that. So that's the stock I'll keep an eye out, particularly because you're getting some valuation comfort.
All right, absolutely. And it's going to be interesting year, especially some of these beaten down large cap names. Sandeep Nandan at Quant, for example, was with us last Friday. And he made similar points that hated large caps of 2024 need to be on your radar. Well, let's talk about GDP, right? Because that's the growth scare, which, of course, is the other one feeding into the markets, apart from all that is happening globally. Now, the government has projected India's GDP growth rate for the fiscal at 6.4% in its first advanced estimates, the slowest pace of growth in 4 years. But let's put all of this into some context. Lata is here with exactly that. Lata, over to you.
Yes, at 6.4, slowest in 4 years. But the bigger worry is that it is slower than Reserve Bank's revised 6.6. And remember, Reserve Bank began the year with a 7.2% estimate, which they held on till October, like 2.5 months back. The positive is that if you take 6.4 full year, we already know first half is 6%. So second half is definitely a recovery at 6.7%. That is Q3 and Q4, which is very good. At least that 5.4 is, that nightmare is not happening again. Let me come to nominal GDP, because this is the first step to making the budget. Nominal GDP has come in at 9.7. The FY24 budget, 2024 budget had estimated 10.5% nominal GDP growth. So there, the GDP growth, the GDP number is 324.1 trillion, according to the advanced estimates. The budget had estimated it at 326.3 trillion. Now, why 2.2 trillion less? Means what? 4.9% of this GDP number will have to be lower. The budget had estimated it, the fiscal deficit, at 16.1 trillion. Now they have to cut their expenses somewhere. They can have a deficit of only 15.8 trillion, some 30,000 crores less. Not a big ask, because apparently they're not going to get to their capex targets. The reliefs, the positives in this number is private final consumption expenditure. The one that we've all been ruining about, that's estimated to grow by 7.3% compared to what? 4% last year. So a genuine uptick over there. To be fair, in the first quarter, it was 7.4. Second quarter, it fell to 6. So looks like definitely there is an uptick in the third and fourth quarters, according to the MOSPI. The other positive is that the rural employment-heavy sector, agriculture, has grown by 3.8% compared to 1.4% last year, which is very good, because that'll mean a little more in terms of real incomes. But the same thing in urban is not happening. Urban, the biggest employment-heavy sector is what you call trade, hotels, transport, communication, and broadcasting. Trade hotels is really big. And there, the growth is only 5.8% compared to, I think, about 9% a year ago. So, this squares with what the FMCG companies are telling us. Rural consumption recovering, urban consumption slowing, stagnating, or even falling. And finally, capital formation is seen at 6.4%, lower than last year's 9%. But it looks like through the year, it is exactly the same number that we got in the first half also. So it looks like that will be steady. It is not that because of government spending, that number is getting boosted up. Looks like private consumption is not kicking, private capital formation is not kicking in. So it's an even 6.4% for the full year. Now, finally, there are people who told us that GDP advance estimates tend to be conservative because they are extrapolating from the first 8 months, which were not very good. Now, I therefore went back 10 years to look at how the advance estimates compare with the actuals. Okay, look at the record. For 4 years, they were higher than the actual numbers. 4 years, they ended being lower than what came out actually. And 2 years, they were bang on. So really, if anybody who thinks that, oh, these guys are being conservative, not so. The record is fairly good in terms of advance estimates.
Okay, so it's fairly even, Stephen, there. Let's see if this time around, whether these are very accurate estimates or whether growth can actually surprise on the upside. That's what, of course, we will hope for, what the market will also hope for. Latha, thank you very much for that analysis. Let's move on and kickstart the equity call of the morning. Rhythm Desai of Morgan Stanley says earnings growth is expected to remain mid-single digits due to weak top-line growth based on our bottom-up estimates. He says margin is likely to expand on sequential basis and believes that the earnings upcycle is still intact and remains ahead of consensus expectations. He says they recommend large private banks, select consumer and industrial stocks, and IT services shares going into the earnings season. That's Morgan Stanley, probably one of the biggest bulls on Indian stocks still on the street.
All right, well, that's some opinion. Let's get one more. And this is Mark Matthews, who's now with us in the program of Bank Julius Baer and Company. Mark, good morning. Great to have you with us on the program. Happy New Year. I think I'm speaking to you for the first time in the new one. So great to see you. Just a quick, so FII selling has continued here in India. And FII weighting, as far as Indian stocks are concerned, is now the lowest in at least 10 years, if not more, Mark. And this is a big underweight because India's weight in the MSCI Asia ex-Japan index is just shy of 20%, about 19.8% or so. So there's a few percentage points underweight that FIIs are running here. What's your sense, Mark? Will that reverse anytime soon, or this is going to be a tough one?
My sense is that it depends on two things, the dollar and the S&P 500. The dollar, as you know, is extremely strong. I struggle to see it going much higher because it's as overvalued as it's ever been based on fair value estimates, basically economic estimates. And then with the S&P, the big question is, do we get a little correction, say 5 to 10%, or could we get a bear market? A little correction is fine for a country like India. It might result in net inflows as people look for alternative investments. But if there's a full-on bear market in the United States, in other words, 20% decline or more, then all bets are off everywhere in risk assets, and that would include India. And I think we're in a very tricky situation now because there are actually some reasons why we could expect a sizable correction in the S&P 500 this year.
Oh, that's pretty interesting, Mark. Hi, good morning and Happy New Year to you.
Thank you.
Why is it that you're expecting finally a correction to show up on Wall Street? I mean, the data is still very strong. Corporate sort of performances have been pretty good, at least up until the last earnings season.
Yes. Well, I suppose that in a way, that's one of the weaknesses of the market is that the consensus does look for 13% earnings growth this year. So we really have to beat 13% to make it look good. That's a high number. And even assuming 13% earnings growth, the PE of the S&P is on 22 times this year's earnings. So that's not particularly crazy expensive, but it is on the rich side. And then you have on top of that the investor optimism, which according to the conference board is at pretty much an all-time high. It's 53% of Americans, as of the last reading, expect the S&P to be higher 12 months later. I think only once before in the history of that series, which goes back to the 1980s, did you have in excess of half of the people surveyed expecting the market to be up the following year. Then we come to all of the foibles that will no doubt be present with the incoming Trump administration. A lot of their policies could be inflationary. And then I think the icing on the cake is the Federal Reserve. We do not think they will cut rates another 2 times this year. At best, we get one more cut, but even that, we sort of 50-50. They don't need to cut rates, especially in an environment where you could be looking at increase of inflation due to policies from the incoming administration.
Okay, all right. Hi, Mark. Good morning. Good to see you in. Nigel on this side. Well, Mark, you're sounding a little bit cautious this morning on global equities itself. The other big data point that we'll be waiting forward to is to see what US President Trump does. And there's a lot of uncertainty on that front. It could be inflationary in nature as well with regard to the action that people are talking about. What's your view? Will he walk the talk? And also, where does India fit in the scheme of things? Because one view is that he'll be a little bit more, lenient or a little bit more friendly towards India. Your take?
My sense is he likes India. I think he likes Indian people. Indian Americans tend to be Republicans, so that's helpful. And with his policies, it's really difficult to know. Number one, he can change his mind very quickly. So he can say one thing and then just the next day do something totally different. But he has advisors, I would say, who do understand global economics and the inflationary nature of a lot of what he wants to do, like the incoming Treasury Secretary Scott Bessent, like the chairman of the Doge, Elon Musk. And so I'm sure those kind of people would be counseling him against some of the really big inflationary things, first and foremost, the tariffs. But I think he genuinely does believe in tariffs himself, and he does want to have more manufacturing in the United States. And I have to admit that he has a point that in any economy, not everybody can be working in the service sector. You have to have jobs for people in manufacturing. So we'll wait and see. I mean, the market did breathe a sigh of relief 2 days ago when the Washington Post published an article quoting informed sources that the tariffs would only be on strategically important sectors, and it listed a bunch of them, and they weren't, they were quite, how should I say, specific sectors, that not very big sectors. So I hope that's the case, but we really don't know. We'll have to wait and see.
All right, Mark, we'll leave it there. Thank you very much for joining us, and good speaking with you, as always, here on CNBC-TV18. Quickly, a run-through of what's lined up here on this program, what's coming up at 9:35. We'll speak with the management of Mahindra Logistics, and we discuss the outlook for H2 of 25. Ajit Kumar of Nomura joins in to talk about the trends in the banking sector. That's coming up at 9 o'clock, 9:20. You'll have Venugopal Gare of Bernstein. He's the market master of the day. 9:30, the management of Uno Minda will be with us to discuss their H2 25 outlook. And we'll have the management of Nuvoco. They're joining us after a couple of years. 9:40 is that conversation. And after that, we talk real estate. So Gulam Zia of Knight Frank India joins us about whether demand is holding up amidst all the talk of slowdown. How is the real estate demand, residential especially, holding up? And of course, it's the economy at 10:15. Lata in conversation with Sakshi Gupta of HDFC Bank and Pranjal Bhandari of HSBC to talk about the negatives and positives of the 6.4% GDP estimate for this year.
Well, time to slip into a short break. We got a lot of stock-specific action we're tracking for you. We get to that in just a bit. For the time being, we run you through the top 10 segment, the stocks we're looking at. We're looking at Dr. Reddy's, Tata Steel, Ashiana Housing, Signature Global, Exicom Telesystems, Tata Tech, Zomato, and GMR Power. All of them will be reacting to positive news flow. Shoba and Ola Electric will be reacting to negative news flow. Stay tuned. We'll come back and get into greater detail on all of these names.
Welcome back. Like we've been telling you, the color across the globe has been a bit of red, thanks to the sell-off that we saw on Wall Street, rising yields, rising dollar, mood's a bit somber, and therefore you're getting a little bit of a dip at the implied open as well on the Nifty. The GIFT Nifty is still holding up, but most of the Asian markets are trading down. What about individual stocks? As usual, plenty to keep our eye on, and our team is standing by with the CNBC TV18 a stock list to watch out for this morning. Top stocks. Vinny, you take it away. Dr. Reddy's, what's the news here?
So in terms of Dr. Reddy's, what we're seeing coming in is they've signed one of its arm in US has signed an agreement with Jaguar Labs Holdings to sell one of its manufacturing, which is in Louisiana, DRLL. This is a US-based subsidiary, step-down subsidiary of the company. When you look at it in terms of the net worth of the company also, it's a bit on the negative side, though the company in the release has mentioned a net worth which includes inventory and all. So let's keep an eye out on that, though we need clarity in terms of the consideration that's coming for the company, because in the release it's mentioned $1 US. So what is it adjusting? That's important to watch out for. Expected completion of the sale is going to be by March 18, 2025, and we'll wait out for some bit more of a clarity, but as of now we're muted to a bit of a green start is what we could watch out for Dr. Reddy's, given that they're giving up on a facility which was not too important for them.
Okay, all right, Vinny, thanks a lot for that. So we'll keep an eye out to Dr. Reddy's. I'm looking at Tata Steel. They've come out with their operational update, and normally it's not a big mover in terms of a stock price, but nonetheless, it looks better than what most on the sheet were anticipating. Production number has gone up by.
I think Nigel, there's a bit of an issue with Nigel's audio. We'll get back to Tata Steel and that operational update in just a minute. But speaking of updates, lots of real estate companies, they've come out with a report card on the third quarter. Back to Vinny for that. I think, Vinny, you're looking at a couple of names like Sobha and Ashiana as well.
Yes, Sobha, Ashiana and Signature Global. Now, let's start with Sobha, because a weak set of numbers in Q3 operational update is what is at least indicated as of now. Yes, year-on-year basis, the sales are up by 18%, but when you're looking at it, overall, there's a decline of 29% on a year-on-year basis. Quarter-on-quarter basis, it's an increase of 18%. Overall, what's led to the weak sales is the performance mainly was dragged by the Bangalore side of the business as well as Gurugram in terms of regions. That led to a weakness, and Bangalore saw a sharp decline in terms of sales volumes. So that is something that impacted overall the performance of Sobha. Ashiana Housing, that also is a muted number that has come in. So we're expecting red coming in for the stock here as well. Area overall, when you're looking at it on the year quarter-on-quarter basis, there's a decline of around 7%, and value of area sold also is seeing a decline of around 32% on a quarter-on-quarter basis. So we'll be a bit muted to a red start is what one could see. Signature Global, on the other hand, good pre-sales numbers that have come in, 120% uptick YOY. Area sold also seeing a good growth, and collections seeing a sharp growth as well. So Signature Global could open in the green.
Okay, all right. I think I've got my audio back. So let's focus on Tata Steel. Normally, the operational update that they give is not a big mover in terms of a stock price. However, it looks pretty okay, and that's why I expect the stock to open up mildly in the green. The production number has come in high by close to around 6%. Remember, in September, they had commissioned their Kalinganagar 5 million ton capacity, so that's what would contribute a little bit. And now the new blast furnace is gradually ramping up as per what the management says. Deliveries as well is higher by close to around 8%. And they're saying it's the best ever Q3 performance that they've delivered. UK, we know there's a closure of the blast furnace, so obviously there is no production out there. However, deliveries are a little bit lower by close to around 12%. But UK is going through its own set of issues, so that's something that the street will digest. Netherlands, though, you have the production number that's up by close to around 48% or thereabouts, because remember, it's on a low base. One of their furnaces were going through a realignment, so that's one of the reasons. And deliveries are up by close to around 18%. Keep in mind, the bump up in deliveries out here, it includes some volumes that were sent to the UK operations of roughly around 0.12 million tons. So that's why, in fact, it got a bit of a bump up. Put everything together, it looks pretty okay. Stock has seen a fair correction from the top. So that's why going with green on this one.
Okay, all right, Tata Steel. So watching out for this one as well. Let's move on now. There's a legal matter that could impact sentiment around Ola Electric today. Abhishek has the details on this one. Abhishek.
Karnataka High Court has rejected the plea by Ola Electric to quash a notice that has been issued by CCPA. Now, CCPA is Central Consumer Protection Authority. CCPA had given a notice as part of investigation into the company. So, Karnataka High Court has asked Ola to submit additional documents following over 10,000, to be precise, 10,466 consumer complaints regarding its electric two-wheelers. In another, letter to them, or let's say warning to them, SEBI has issued a warning to Ola Electric. Ola had made an announcement of the fourfold expansion to the exchanges at around 1:30 p.m. while the chairman had tweeted the same at 10 a.m. on Twitter or X. So over there, an administrative warning has been issued to Ola by SEBI. Back to you.
Okay, thanks for that, Abhishek. We'll keep an eye out on those stocks. But Vivek's got a few more stocks that he's tracking. Vivek, take it away.
Good morning. Quite a few stocks on the radar. It's on the back of news flow. First on the list is GMR Power. So now, IREDA, which had sanctioned close to 2,128 crore worth of loans to the company, to various SPVs that the company had set up. This was to go ahead and install smart meter electricity projects. So the company now has gone ahead and extended a corporate guarantee in favor of IREDA. This is for loans of close to 440 crore each for each of the SPVs. Now, the second stock on radar is Xtcom Telesystems. The company has formed an MOU with Mufin Green Infra Limited. This particular MOU is for installation of EV chargers and setting up of EV charging infrastructure. Zomato also keep this particular stock on the radar. Yesterday was a laggard, but an interesting development over there. The company has gone ahead and started a 15-minute food delivery service. This service is already live on the Zomato app, and this will go ahead and create competition as far as Swiggy's Bolt service is concerned. Also keep an eye out for Tata Technologies. The company and Telechips have gone ahead and signed an MOU. This is to innovate solutions for next-gen software-defined vehicles. The collaboration will focus on solutions for advanced driver assistance system platforms. Expect some green on Tata Tech as well.
Okay, all right, Vivek, got that. Thank you very much for those details. Let's quickly recap our list of stocks to watch today. The ones that have positive news around them are Dr. Reddy's, Tata Steel, Signature Global, Xtcom Telesystems, Tata Tech, Zomato, and GMR Power. The stocks that have negative news around them are Ashiana Housing, Sobha, and Ola Electric. Okay, so that's our list. Let's move on and talk commodities now. We have Manisha joining in with the latest from the commodity markets. Manisha, good morning.
Morning, and Sylvie, thank you for that. Well, a bit of a pullback in dollar index and the treasury yield has led to support in many of these commodities. The best of the gainer until now in 2025 continues to be the crude oil prices, which are now trading at a 3-month highs. We have seen prices gain up by 4% in this year until now, and this is after 2 years of constant decline. So this year has started very strong for the crude oil prices. But not just crude. When you look at across metal prices, we're doing quite well. Copper prices are holding gains on dollar pullback. You have gold, which is back above 26.50. Silver is trading at around 3-week highs. Aluminum prices, which started this year at 3-month lows, also have seen a smart rebound as the available LME stocks have continued to decline. Platinum is trading at a 7-month high. So as I said, almost everything in commodities is trading in green right now because of a bit of a dollar decline.
All right, Manisha, thank you very much for that. So that's commodities in focus. Well, let's move on to some corporate stories here. And this is the long-running Jayaprakash Associates resolution case. Sources are now telling CNBC-TV18 that a number of asset reconstruction companies, ARCs, have shown interest in acquiring JP Associates loans in the lender-driven auction. Basically, lenders, ARCs lining up to buy debt from banks. Ritu is here with what she's picking up. Ritu, good morning.
Good morning, Prashant. As you said, there are 6 ARCs at least that have shown an interest in acquiring the Jayaprakash Associates loan from the lenders. And this was sparked after, as we've been reporting, the National Asset Reconstruction Company made a 12,000 crore rupee offer to acquire this loan from the lenders. So, from the likes of JM Financial ARC, Phoenix ARC, Arcel and Eka ARC, several of them, we understand, are currently conducting a due diligence to make an offer for this large account when the auction does take place on the 14th of January, which is the extended deadline from the earlier 7th of January, which was, extended because of the request coming from the suitors. Now, this is because RBI guidelines mandate that there be a public auction to conduct such a sale to an ARC, and therefore banks have said that 12,000 crores that was offered by NARCL as a reserve price to conduct this auction. Of course, NARCL will be allowed to match or better the highest offer that comes in. Now, the offer from NARCL, while that is under your standard 1585 method, which is the typical sale to ARCs, 15% as upfront cash payment to lenders and 85% in the form of security receipts. Now, we understand that banks have invited counter offers in an all-cash deal from prospective suitors, which some participants believe can dampen the demand, especially from the smaller ARCs. Now, remember, the resolution of this company has been stuck for more than 7 years, finally admitted to the Insolvency and Bankruptcy Court in June last year, claims of more than 52,000 crores from more than 24 lenders. Now, while that IBC process is running in parallel, but it is facing litigation-related delays, and therefore lenders are fast losing patience and looking to offload this asset to an ARC now.
All right, Ritu, thank you very much for that. So maybe there will be movement. Stock, of course, I mean, about $5 or $6 for now, Jaiprakash Associates. We'll take a quick commercial break here. We'll come back. Deven Choksi of DR Choksi FinServ will join in with some fundamental stock conversation on the other side. Stay tuned.
Welcome back. Well, time to kickstart our first corporate conversation on the show today, and the company in focus is Mahindra Logistics. Now, the management has been fairly confident of doing about 10,000 crores of revenue by FY26. That's been their longer-term roadmap. But how are things on ground, considering there's this widespread talk of overall GDP slowdown? Well, we have with us Mr. Rampraveen Swaminathan, MD and CEO at Mahindra Logistics. Mr. Swaminathan, thank you for joining in. Season's greetings, first of all. Very happy new year to you. So, I guess your fortunes are pretty closely tied with what's happening in the economy. And the chatter is all about this slowdown. 6.4 is probably not a bad figure, but it's a big dip from 8% plus growth that we saw last year. So you tell us, are you seeing any green shoots? Are you expecting a pickup in the second half? And what do you see for your business in terms of revenues this year?
Morning. I think we've been talking about the slowdown in the past couple of quarters as well. I think Q3 has been a bit of a positive turn. Obviously, we've seen volume growth driven by festive demand, good healthy growth on the e-commerce side, and kind of stable movements on the automotive, especially the passenger vehicle and the two-wheeler sides of the market. So I think it's a bit of a mixed bag. Obviously, there is stress, but most of our business lines have actually shown pretty healthy volume growth in the third quarter. There is obviously some challenges in elements, but broadly, I think a good quarter recently. And I think we're confident about the second half in terms of overall growth. Should be back to the kind of probably a bit short of the growth we saw in 21, 22, 22, 23, but kind of in line, picking up on growth, both just through organic volume growth and just account expansions we're seeing.
Can you help us, put a range to that, some sort of numbers? I think the last time you did say that you were hoping to clock at least double-digit growth for the full year. But now that you're sounding quite confident, it's great to hear you on the third quarter with a lot of the segments picking up. Could it be, in mid-teens? Could it be high teens? Some more idea about that optimism.
I think just sheer volume growth is in the mid-teens, right? And we kind of are fairly consistent with what we had said earlier. Of course, one must note that we are subject to global freight price movements in our cross-border business. And obviously, the regional distribution which we do does impact the actual revenue we have. But underlying volume growth in terms of boxes we shipped or boxes we delivered, facilities we run, I think that is seeing mid-teen growth in the third quarter, and something which I believe we will sustain over the next few quarters as well, just on the back of both new contracts we're winning and just in account or inside growth.
Okay, all right. Hi, Mr. Swaminathan. Good morning and good to see you in. This is Nigel on this side. I think e-commerce is high teens, right? 18 to 20% of your total mix. You could correct me on that number. Has it seen an impact because of quick commerce? And are you supporting quick commerce in any way?
Yes, I think obviously the standout growth areas obviously continue to be quick commerce and probably grocery. And we are quite active in that space, both in terms of fulfillment centers we operate for customers, as well as in terms of last mile delivery. So those areas actually have seen probably the most step up growth in the third quarter, and something which I think will sustain in the fourth quarter as well.
Okay, so that's good to hear. You're active in quick commerce and overall, of course, e-commerce as well. What about autos? I mean, some more color on how these individual businesses are moving. On autos, what's the pickup like? And also give us a sense on the warehousing business, what your expectations are from that for this year.
So I think the automotive side, we have continuously stable growth. I think it's not obviously, I think I've mentioned this earlier, it's kind of come off the kind of correction which we saw in the early part of in 21, 22, 23, the last couple of years. But good stable growth, especially on the passenger vehicle side. I think obviously your revenues are impacted by a shift to multimodal. We are working with our customers to do a fairly significant shift towards rail freight, which is around 17-18% of our volume today. That does impact the revenue mix in the yield, but underlying volume growth has been in the teens, and we are seeing a reasonably good outlook in the fourth quarter as some of our customers are launching new products, and that should give us a volume lift as well.
All right, we'll leave it there. Mr. Ram Praveen, appreciate you joining in, and all the best as you navigate 2025. We'll speak again soon. Thank you very much. There's 15 minutes to go as far as the market open is concerned, the pre-open at least, and then we'll get down to it with regards to specifics really here. But Deven Chokshi is with us. He's been waiting by. I'm Managing Director at DR Chokshi FinServe. Deven, good to have you with us here. Good morning. Thanks very much. Let's start with a big one, Reliance Industries. After many days, that's showed some signs of life, was up about 1.7% or so. I think I saw two calls. One is Bernstein, and I think there was another one, which are now starting to essentially refer to the fact that valuations have come into very, very attractive kind of levels. Maybe it needs triggers or whatever. But what is your own sense, Deven? RIL, buyable these levels?
Hi, Prashant. Good morning. Well, considering the fact that in 2025, we are likely to see the separate listing of geo platforms, that is going to be the valuation unlocking. That is what we expect out of Reliance in this particular period. As such, I think the geo platforms annualized basis is talking about 1,20,000 crore worth of revenue and about 60,000 crore worth of EBITDA. So obviously, I think this particular listing, separate round out geo platform, would mean that valuation unlocking would probably, I think, start digging in from Reliance and shareholders. Significantly important, I think Reliance Retail going forward is on a similar course as we believe. So I think both these possibilities could possibly drive the stock price. Whatever the second quarter earning impact came because of the issues in the refining business, I believe that I think it's a matter of past. I think the business condition looks much stable now. And maybe I think the workings of the company in the third quarter will be normalized as far as the refining business and its margins are concerned. So overall, I think our approach is to consider buying this particular stock in the portfolio. We continue to hold, but I think we continue to buy in corrective downside as far as the investment outlook is concerned. We remain positive on that.
Okay. Deven, hi, morning. Good to have you on the show as always, and Happy New Year to you. I want to talk to you about the jewelers, because if there's one thing that's not slowing down, it's jewelry demand. Very, very clear, because the updates from both Titan and Kalyan were very, very encouraging. And especially Kalyan. I mean, Kalyan is still growing at close to 40%, their India business. How do you look at some of these listed plays? The problem is stock prices have run up so much. We were just discussing this yesterday. 2 years ago, Kalyan used to be, I think, around 150. Today, Kalyan is at 750, 770 thereabouts. So not sure how much is still left on the table. Your thoughts?
Yeah, good morning, Sukhbir. Wish you Happy New Year as well. Well, I believe that I think, as you rightly said, everything is in price today. Definitely demand conditions remain absolutely very, very bad. And the jewelry market is certainly attracting the higher amount of wallet share from particularly urban consumers, more importantly for the listed companies. But even if you go to tier 2, tier 3 cities, I think some of the small-time jewelers also are having buzzing business. So which means that allocation of money by the urban consumer as well as rural consumer is moving towards the gold and the gold jewelry related businesses. So from that particular point of view, yes, I think the business condition looks, I think, quite stable for them. Not too sure whether it's a buy opportunity, particularly because I think everything is in price. These companies, they operate out of thin margin as such. And probably, I think one will have to see how exactly the higher valuation sustains. We like the activities, I think, because the consumer is spending, but at the same time, the valuations are not allowing you to consider it.
But Titan, I mean, just to follow up on that, Devin, Titan hasn't done anything this year, right? And the market is talking about going back, looking for large caps, which have been ignored. So does Titan fall in that category? It has pedigree behind it for sure.
Good company, but valuation stays all. Like the valuations are not cheap. Right? And I believe that unless you have corrected valuation, I think one will not be actually buying the stock immediately.
By the way, you guys talking about Titan and Kalyan jewelry. Look at Goldium International. Not artificial, sorry. I should correct myself, lab-grown diamonds.
Yeah.
Goldium was up 18%. It'll come up on your screen. I don't think it really has any institutional investors or anything of that sort. But I think it's got one large individual investor. That's about it. Big gains. I think a year ago it was $150, close to about 500 rupees now. And I remember asking that question about lab-grown diamonds to the Titan management for the last, I think, 8 quarters. Slowly that, at least I, maybe looking back, I feel the acceptance, the realization, and of course, I mean, I think they're also now starting to, through other arms, sort of make forays into the lab-grown diamond space, retailing them, etc. But that's another big one. Devin, any thoughts on this one at all? I don't know if you have coverage, own it, seen it, Goldium?
We have not covered Goldium, but lab-grown diamond business as a whole, I think we have been following it for the last few many years. I believe that I think this business is going to grow and grow big because ultimately the consumer wants to spend money provided it is affordable. And earlier theory was that diamond was bought for the purpose of as an asset class. In the lab-grown diamond, I think they use it for the purpose of consumption. So certainly, I think this particular activity is likely to grow. We are likely to see some of the larger players also from the diamond industry getting into the lab-grown based diamond and very in times to come from now. That's what we gather. Zurio is something which Tata Trent has basically created, in which the lab-grown diamond jewelry business has started. So in my viewpoint, I think this is going to grow big, but we don't have cover in Goldium, so won't be able to speak much about that now.
Just to round up this conversation, I was trying to rack my brain because I read this just a couple of hours ago. Finally, the name came to me. It's De Beers. De Beers is partnering with the Gems and Jewelry Export Promotion Council, the trade body, to promote natural diamonds. The fight between lab and natural is so real that a huge giant like De Beers has thrown its hat in the ring, saying we need to protect our turf. So they're going out to trade bodies, export bodies, saying no, natural is still the way to go.
You go to movie halls, theaters, and I think I've seen those ads in it becomes too repetitive, but exactly that.
Yeah.
Natural diamonds are natural diamonds. I mean, that's a real thing. That's a real stuff. So of course, I mean, the industry will push back. Absolutely.
It's a tough turf to protect, I'm sure.
It's a tough turf.
Diamond expert here.
It's tough to keep the wife away from thinking about diamonds, whether natural or this.
That's why he's silent.
Devin, let's get back to the stocks, Devin. I want to ask you about a couple of these sugar-based, companies like Balrampur Chini as well. The hope was that we're going to be hearing something with regard to an ethanol price increase, which has got delayed for very, very long. And that's why these stocks have been weakish. Now that chatter is back. What's your view on these stocks at current reckoning?
So, Nigel, we do like, I think, the entire ethanol component in the sugar space, and certainly believe that it is because of ethanol, the re-rating of most of the sugar companies definitely has happened. Going forward, I think this is likely to continue further as well. However, I think with one caveat that the policy regime of state government as well as the other central government on various aspects, I think, will always, affect this company's near-term activities. So from that perspective, one remains a little bit mindful. Whether I think one could buy the portfolio, I think structurally the change has already happened, and most of it, I think, is set into the price. But corrected downside in some of the stocks, I think, would probably mean that there will be some headroom opportunities available in this. We remain clear about it that the entire activity, I think, of mixing the ethanol with the fuel is definitely going to gain further momentum, and the policy regime is, I think, definitely supporting that.
All right, Devin, we'll leave it there for now, but we'll take a quick, commercial break at this stage. Mitesh and Sudarshan are going to be with us as well, and we will run you through some technical trading ideas. Stay tuned, coming up.
Welcome back. As promised, let's get in our technical experts who have You go first. Yesterday, we had some kind of a pullback from the kind of losses that we saw in the previous session. This morning,
yeah, good morning. See, that pullback was there, but it was very mild, and markets traded in a narrow range. My idea is that the Nifty must prove that it is willing to go higher. Essentially, for me, the levels are about 23,800. So if the Nifty crosses this number, this resistance zone, and then stays above it, gives a sense of comfort, then a long position is justified. Otherwise, the best trade in the Nifty is, so far it remains below 23,800, to completely avoid it.
Nifty, that's the call till it's below 23,800. Got that. Mitesh, what about you? Which side are you drifting to?
Nigel, I've been having some kind of a negative bias, primarily because of the Bank Nifty view, which I believe that unless until 50,500, 600 zone is cleared, I think the Bank Nifty is negatively biased and could not only retest the lows of 49,700, which is a very critical support area, but maybe, break it in case we don't see an upside reversal. So for the time being, the view is very similar to what Sudarshan said. I think, at the upper end, we are trying to get into short positions. Though on stock-specific basis, I have some long ideas as well. But broadly, we have put spreads on the Bank Nifty and would want to short futures as we get closer to the upper end, because then the risk-reward ratio is much favorable to your trade.
Okay, all right. Gentlemen, stay on. We'll come back. We also want to get into individual stock trades, but a quick break. Back in a moment. Welcome back. 14 minutes to go before we start getting our rates. The pre-open has started, but let's see. Right now, there's a lot of exuberance. 270 points pop. That's what the first pre-open rate is giving you. Let's wait for it to settle. Back to Mitesh as well as Sudarshan for their stock ideas. Mitesh, morning. So what individual names are you working with today?
Good morning, Survi. I have a buy on Maruti. Couple of days back, we saw a big breakout in auto stocks and Maruti was leading from the front, and last 2-3 days has been kind of a mild pullback. Now is a good time to enter with a stop below 11,500 for a first target of 12,200. Also buy on Bajaj Finserv, with a stop at 1659 for targets of 1745. One sell call, that's Bosch. Keep a stop at 33,350. Look for targets of 32,200. And Biocon, with the disclaimer that we have some options positions over there. Biocon is a buy with a stop at 370 for targets of 410.
Morning, Mitesh and Sudarshan. Sudarshan, what would your advice be?
Well, it's a very mixed bag, and that is because I'm uncertain about the market behavior today. That happens sometimes. I have two intraday shorts. One is Aditya Birla Fashion, intraday short with a stop above 275, and Union Bank, an intraday short with a stop above 114. There are two buying ideas. They're essentially buy on very sharp dips. So these are not day trades. I think you have to consider them as positional trades. RBL Bank is a buy with a stop under 150, and LTTS is a buy with a stop under 4,700.
Okay. Mitesh, what would your stocks? Okay, I think we have that in the bag. We'll speak again, gentlemen. Thank you very much, Sudarshan and Mitesh, for joining us with those trades. I think things are settling down in the pre-open, and just have a quick look at it. And then we'll go across to Rajesh, who's with us. 50 points higher, 23,760, but this is still 2 minutes in and about 5 more to go. Rajesh Palvia is with us, Vice President, Technical and Derivative Research at Axis Securities. Rajesh, good morning. Good to have you here. Again, a little uncertain, a bit of a fix whether from these higher levels, hourly, daily averages, market sells off again, or the damage has already been done and we are in for some reversals. What would your overall sort of setup be? And then, of course, your trades.
Good morning, Prashant. So we have witnessed a pullback from oversold trajectory. The pullback is still struggling to cross 23,800, 23,850 zone, which is an immediate hurdle for the Nifty based on the call concentration. However, on the downside, 23,600, 23,500 are important support area for Nifty for near-term perspective. If he continues to hold about 23,600, I think there is a possibility that Nifty may attempt to give breakout about 23,800. And if it's happen, then possible rally can extend to 23,900, 24,000 kind of level. Bank Nifty is looking little weaker compared to the Nifty, and Bank Nifty has broken 200-day moving average in the previous day. If it's sustained below to 50,500, I think we may see furthermore downside towards 50,000, even 49,800. That's the previous swing low of November month. So I think Bank Nifty is crucial until the Bank Nifty not crosses above 50,500, 600 zone. Trend is likely to remain on the weaker side for Bank Nifty. To initiate this up move of Nifty, we are focusing on 23,700 call option, which was closed at around 124. So if you get opportunity around 105 to 100 level, you can buy this call option with the stop loss of 70 rupees, and on the high side 155 to 170 would be the target on the high side. On the stocks front, insurance space is looking good. SBI Life can be looked at for buying side. 1530, 1540 target we are focusing. Keep your stop loss around 1440. Another stock on the long side, that is JK Cement. Very strong buying action in last couple of weeks. We believe that this upward momentum can extend further. 4900 to 4950 would be the next target. Keep your stop loss around 4760, and one short call on Tata Power. Series of lower top, lower bottom formation. So we believe that further more weakness may continue in Tata Power. Downside target we are projecting towards 360 to 355. So one can go short in futures with stop loss of 395.
All right, Rajesh, got it. Thank you very much for joining in and giving us some of those trading calls. Well, that's the market and a couple of trading cues that you can work with today. But back to more analysis. And now we're putting the spotlight on the banking space. We've got a whole host of Q3 updates from a lot of lenders, from NBFCs as well. And some of the early trends indicate that A, obviously there is stress in the MFI segment, but B, this whole fight for deposits. While banks are able to mobilize deposits, the question is at what cost? Is the cost lower credit growth? Is the cost lower CASA? That seems to be the takeaway from a lot of the Q3 inputs that we've got so far. Well, let's take this up with Ajit Kumar, who's Vice President, Equity Research, Banks and Financials at Nomura. Ajit, great to have you on the show. Thanks for taking the call this morning. And what I just summarized was at least some of the key trends that I noticed. And I remember looking at the HDFC Bank update very, very closely. They managed to, shore up deposits by almost 16% year on year. But look at where that deposit base is coming from. It's term deposits, which are costly, and their CASA has been coming down. Now, is this limited to just a few banks, or is this symptomatic for the whole sector? And therefore, in this environment, how should investors approach banks?
Yeah. Thanks, everyone. Thanks for having me. Good morning, everyone. So, Surbi, just one thing, I cover NBFC here. Param is the one who covers, banks.
Okay.
So, probably I can give you, our outlook on the NBFC that we published recently, if that is okay with you.
Sure, absolutely, Ajit. So on NBFCs, right. I mean, let's start with the good news first, and then we'll come to some of the some of the more concerned asset quality areas. Larger NBFCs, for instance, Bajaj Finance, etc., they've still managed to show pretty steady growth in AUM. What are the key trends that have come to surface for you?
Yeah. No, you're absolutely right. They reported their 3Q25 pre-quarter numbers, and it was strong across all the parameters. Loan growth was strong at 28% YOY, which was in line with our estimate. But more importantly, customer addition at 5 million was highest ever. Even new loans booked at 12 million was also highest ever. This is strong loan growth, record customer addition, and new loans booked highlight, growing confidence in the asset quality side. So just to rewind, management had guided for roughly 205 basis point of credit cost in FY25. which should be, I think, largely fine. Maybe actual credit cost in FY25 would be 5 to 10 bips more than that, but that's it. I think market, or investors in third quarter result will be very closely tracking the credit cost number, which is increasing for all the NBFCs from past, let's say, 10 to 12 quarters. On the positive side, we expect credit cost to peak out in third quarter for most of our coverage companies, which excludes, MFI companies for the time being. And then from 4Q onwards, we expect, credit cost to normalize. And if NBFCs can control their asset quality issues to a certain extent, that along with only the narrative of rate cut would be enough to keep things fine. So our sense is this quarter is going to be kind of a pivot quarter where we are going to see some kind of stabilization in the credit cost side, and which is going to be positive for NBFC stock.
Okay, all right. Good morning, Ajit, and thanks a lot for joining in. Ajit, let's talk about a couple of stocks. And when you compare stocks with their historic valuations, the one that stands out is Bajaj Finance. It's gone through a period of, consolidation, a bit of underperformance as well after having a dream run for close to around 10 years. You have upgraded the stock. Give us the top 3 points because with regard to this upgrade.
I think with Bajaj Finance, the loan growth was always the strong point with them. Even if you look at last 10 years, CAGR loan growth has been more than 30%. From past, let's say 1 year or 1.5 years, what is bothering the investor is the credit cost trajectory. If you look at, their cross-cycle credit cost, it ranges somewhere between 120 to 150 basis point. But let's say from last 1 year to 1.5 years, the credit cost has been a little bit on the higher side, somewhere between, let's say, 180 to 210 basis point. That is something which is kind of, bothering the investors. And this is also understandable because if you look at the loan composition, roughly 35 to 40% of the book is unsecured in nature. And in last 1 year or 1.5 years, we have seen, increase in delinquency in the unsecured side, whether it is personal loan, whether it is credit card loan, whether it is microfinance loan. Now, on the margin, at least in personal loan and credit card, things looks to be improving. First of all, growth has slowed down, across all this unsecured segment, whether it is banks, whether it is NBFC. For banks, unsecured loan growth in personal loan has come down to single digit. Even for NBFC, recently RBI put out in the financial stability report, your unsecured loan growth even for NBFC have come down, let's say from 45% to 35%. So loan growth has come down. There is some bit of consolidation which has happened in last, let's say, 1.5 years. RBI also highlighted in its FSR report that incremental credit in the unsecured space is coming from the more prime customer rather than from the, let's say, subprime customer. So on the margin, it looks to me that credit we should be somewhere near the peak of this asset quality problem. At least in the personal loan and credit card side, we are still, by the way, very negative on MFI as a space. But yes, I mean, Bajaj Finance is not very, not much present in the microfinance side. They are, mainly present in the personal loan side, where things on the margin is looking to improve. And if they can contain their credit cost, broadly within the range of what they are guiding for, and their guidance is roughly 205 basis point in FY25. I think if the actual outcome is nearby, that number, our sense is this stock is, ripe for re-rating.
30 seconds, Ajit, is so, because there is, for financials, the investable universe is banks also, right? Which are also, I mean, it's the constant refrain that it's attractively valued, large banks. So are NBFCs a bit of a hard sell right now when you meet investors? Why not buy a large bank, I mean, at a cheaper valuation? Or and if they had to pick one or two names, one would be Bajaj Finance, and anything else? Go on.
Yes, so we have upgraded, SBI card as well recently, along with Bajaj Finance. We upgraded both, and the argument broadly remained the same here as well. Even in credit card, lenders have taken corrective steps, and as a result, lenders, including SBI card, have cut down on the lower quality borrowers. For example, at the industry level, share of metro region is going up in the credit card mix in last, let's say, 1 to 1.5 years, reversing the trend that we witnessed during FY21 to 23. In last, let's say, between FY21 to 23, higher sourcing from riskier customer cohort like non-metro customer, younger population, self-employed customer was the main reason for asset quality deterioration at the first place, which is now reversing in, let's say, last 1 to 1.5 years. At the same time, your leverage level or limit per account, everything has been going down in the non-metro region versus, let's say, metro region. So all the low quality customers are being removed, and that is why credit cost looks to be that it is going to peak out in next few quarters. Yeah.
Thank you for joining us. Appreciate you coming on. We'll speak again soon. Longer chat, but helpful. Bajaj Finance and SBI car, 2 upgrades coming in from Nomura. Standout brokerage reports. What's on the list? Nimesh is standing by with exactly that. Nimesh, good morning.
Hi, morning, Prashant. So today's standout is on cement. CLS is turned constructive, and they believe that the earnings visibility is improving, and hence pocket of opportunities are arising. Today they've upgraded Dalmia to outperform from hold, and they've raised the target price there to 2110. They've also upgraded ACC to outperform from underperform. So technically it's a double upgrade. And on ACC, they have raised the target price to 2580. Now, the key themes for 25, according to CLSA, 1, demand recovery, 2, consolidation and capacity expansion, and 3, profitability because of the low base and cost savings. In terms of individual names, they continue to prefer Ambuja, so they have an overweight stance on Ambuja. So that's the first name. On Dalmia, they've upgraded the stock because while there's a lack of near-term or medium-term earnings visibility, it's already in the price. So that's the reason why they've upgraded the stock today to outperform. On ACC, while they've upgraded after the recent underperformance, they prefer to play the group of Adani through Ambuja. So that's a call there on Ambuja. On Ultratech, while they like the stock, they believe the risk-reward is balanced at current valuations. And they only have an underperform on Ramco Siemens because they're waiting for more visibility in terms of medium-term growth. But the big call is they've turned constructive on the cement sector. And today, CLS has upgraded both ACC double upgrade and on Dalmia to an outperform from hold earlier.
All right, interesting one there, and we'll track what the reactions are as far as stocks are concerned as we open up. Nimesh, thank you very much for that. More specific stocks and attention coming up on those in a little later. But market open is upon us, so let's just quickly run you through what that will look like in just a bit from now. So counting down, first few seconds, we'll look at, of course, indices, and we'll go down to individual stocks, etc. So we're the pre-open has left us with about a 38-40 odd point pop, and we'll see if you're able to hold on to it and do more maybe. So the first reactions are coming up. So 23,752, it's absolutely flat. The Nifty Bank has slipped into the red, but barely so, but some red there. 0.14 down. The mid-cap index is down, is flattish, but I mean nothing really as far as changes are concerned on the indices. The sensex also absolutely flat. So nothing very much to show for, at least at the start at an index level. Stocks, of course, I'm sure will be a different kind of a reaction. Individual names would be popping up and selling off as well. The Nifty heat map should come into view, and they'll give you a first sense of what the overall picture is looking like, because the index is flat. So more down than up, 30 down, maybe 32, 33 down, and about 15, 18 stocks which are higher at this point in time. 10 points down on the Nifty. Surabhi.
All right, let's break it down and get into stocks then. Very, very flat on the Nifty, at least as of now. So let's see where the red is coming up from. Shriram Finance, Tech Mahindra, IndusInd Bank, SBI Life, Infosys, Wipro. So the early trends are telling us that financials and tech not looking too hot this morning. HCL Tech is down about 0.5%. Infosys dropping almost 1%. Let's see what TCS is doing ahead of numbers which come out tomorrow. TCS is absolutely flat for the time being. BEL, Bharti Airtel, HDFC Bank is quite weak, about 0.5% lower. So financials and tech, not that great. Let's see the other side. Dr. Reddy's is reacting well to the fact that they're selling off one of those units in the US, I think, which is not of much use to them. 3% up now on that stock. ONGC is continuing its solid form from yesterday. Remember the CLSA note, which is very, very optimistic on ONGC. Another 2% on that stock this morning. And the positive brokerage commentary that we've seen on Reliance, that's rubbing off well on this one. RIL is up 1% as well. L&T is having a decent morning. Eicher Motors seeing some buying as well. Actually, M&M also on the upside. Autos largely are okay. M&M, Maruti, Hero, Eicher. Some green on autos, green on ONGC and Reliance. That pretty much sums up the picture. Actually, ITC and Lever as well. Some of these FMCG heavyweights, coupled with Reliance, are offsetting the weakness that banks and IT are showing at this point in time. So it's absolutely neutralizing itself. Banks and IT down, but you've got some of the other big boys holding up the green end.
Okay, all right. Let's focus on a few stocks. And Spandana Spurti continuing the gains that we saw yesterday. Bazooka move yet again. Massive volumes on that one, up 7.5%. Indofarm Equipment listed yesterday, ended in the green. Today, in fact, it's building onto that, up to around 5%. Aegis Logistics, if I remember correctly, Jay Bala was quite positive on the charts with regard to Aegis Logistics. Yesterday it went up, I think, 15%. Today as well, it's up close to around 4%. So solid move is what we're seeing on that particular name. What's not doing too well? Ola Electric, not the one for the faint-hearted. For the time being, the negative news flow is weighing on the stock, down close to around 3%. ITI, definitely not the one for the faint-hearted. Yesterday, the stock was down 10% from the top. In fact, today it's down another 5% or thereabouts. And Kalyan Jewellers, the sense you get is that the street has read something more into it, because the operational update wasn't bad. From yesterday's high, it corrected close to around 5%. Today, it's down another 2.5%. We'll have to wait by to see what's the news flow on this one. But that's clearly a spot of bother out there. The stock is down even as we speak. So the headline index is more or less flattish. The mid-cap index, well, a little bit lower than what the headline index is doing, but plenty of stocks moving around. Ashiana Housing doing well. Borosil Renewables as well is higher in today's trading session. So big move is what we're seeing on a couple of these names. On the flip side, a couple of stocks that are losing out. You have TBC that's down close to around 5%. ITI is moved even lower as we speak. Prashant.
Well, lots happening, isn't there? And Reliance, by the way, those positive notes and the damage in the stock, about 1% pop this morning as we start a new session. I mean, this is as flat as they come on the Nifty, right? I mean, less than 5-point change, nothing at all. And you've got the Bank Nifty, which is slightly lower. So that's the start, slightly slow and sluggish. Venugopal Gare is now with us. He's a market master today, managing director, India head of research at Bernstein. Venu, good morning. Great to have you back on the program. Thanks very much. Venu and the team at Bernstein, of course, were one of the first who started cautioning about this, slowdown in growth momentum, business cycle momentum, risk to earnings, etc., etc. And all of that has played out, especially in H2 of FY25, starting, I think post-July, post-August or so. So, those things have panned out. And where do we stand now? Prices will move ahead of news flow and actual data, etc. So is there any sense in trying to be slightly ahead? So what I'm getting at is, if the slowdown, etc., is materialized, should we try and price some sort of a reversal at an underlying growth level? And then, of course, for stocks as well. Basically, start to dip your feet and start to buy stuff at the margin. Your thoughts?
Prashant, thanks for having me on the show. I think you have given a very good backdrop. I was about to say and claim some victory for last year's weakness in macro, but you sort of laid it out for us. So just to put in perspective that my thinking is pretty much similar to what you're saying, that after being cautious last year with the 23,500 Nifty target, with the view that macro would weaken, earnings looked frothy with room for cuts and of course no upgrades, we are in a situation where to a large extent, in my view, macro has bottomed out. Bottoming doesn't mean that we are going to swiftly move up to an amazing economic story this year, but yet bottoming itself is a pretty interesting thing to watch, because when macro bottoms, you also tend to see incremental earnings risks also tend to reduce beyond what you would have already modeled, which is pretty much setting up you for a situation where in this weak phase, in my view, one should be buying stocks. So we've sort of reversed our stance of being cautious to not buying in general to a situation where we want to be a bit more proactively this year, especially in the first half when things are weak, to be buying equities. Target for the year is 26,500, which is 12% or returns at a Nifty level. It's a good enough return in my view.
Okay, all right, Venugopal. That's really good to hear. So good, good start to 2025 then, because you've been, of course, one of the more cautious voices on the street for the better part of 2024. But I mean, we've heard everything you've said. You're saying that macros are bottoming. This is the time to go out and start buying stocks. So let's get straight to it. What's the construct then? If you were to create a fresh portfolio right now, I mean, what would get top billing?
Yeah, so, the way it works is the ways to play through the year will change. In terms of the sector construct that we have today, 3 months later will be different. But the idea is that at this juncture, we are overweight financials with a slightly lower weight than we had last year. And the idea is that macro bottoming out and recovery is still a 2-3 quarter process. So we're going to
probably strengthen our weights on financials through the year, but at this juncture, we're overweight financials. IT services, we've actually increased weights. If you look at any near-term damage that you see from an economic standpoint, being exposed to potential positives coming in from US, rupee depreciation, which has already played out to some extent, but rupee is still a bit overvalued. So to the extent you still have some depreciation tendency left, IT services probably is a much better way to play that, given that we are moving off a relatively lower growth phase of last 3 years to maybe an okayish phase. So that's like the trend line. We also decided to upgrade utilities to overweight. The idea out here was that it's relatively more safer and calmer as a space, and you would have seen the damage in terms of stock prices last year, especially in the second half for utility stocks. Telecom is an overweight for us, but that's a continuation of last year's overweight. There are various ways to play that, but the reality is that it's a relatively more steady annuity sort of a business, which is not really too impacted by macro, in a major material way. I would probably say that these are the ways in which we are sort of playing. We are still sort of neutral-ish on consumer, even though we upgraded consumer staples from an underweight to sort of equal weightish per se. And the sectors which we still don't like are sectors like industrials, where we think that they're still overvalued. And the better way to play that is through utilities.
Okay. Hi, Venu. Good morning and good to see you in. Wishing you all the best for 2025. You know, you've given us the upside target, 26,500, give and take everything. You're still factoring in a 12% increase in this year on the Nifty. But I think given the current market construct, the street would like to know what is the downside risk as well. On the downside, you know, where could we visit? If you could give us a level out there, point number one. Point number two is on earnings. Clearly, the street is very, very nervous with regard to earnings growth. And it appears FY25 is going to be a weak one. But all hopes are on FY26. So what are you all factoring in terms of earnings growth? Downside as well as earnings growth. Please go ahead.
Yeah, so first, let me give you the earnings construct. Look, we all have data. We all know what's going to happen in the near term. The earnings picture is not that great for FY25. First half of the year, we were close to flattish, especially for large caps in terms of YOY growth. Second half, there's an expectation of 15 to 18%. Highly unlikely that we achieve that sort of a big lift YOY. So what it means is for the full year, you end up at sub 10% sort of numbers from a growth standpoint. But as we sort of look at the broader thinking about economy itself bottoming out, and there are a lot of things which did not play out last year. For example, capex did not play out last year. Consumption was, in general, fairly weak from a YOY base perspective as well. These are the things which would start to pick up in the financial year FY26, which is somewhere 2 quarters from now, which is where for next year, we would probably be of the view that there would be relatively better earnings growth compared to what we've essentially seen in FY25. Now, from a next 2 year perspective, my broader macro forecast is for a 6.5% plus GDP, and not the 5.5% that you see in that you saw in the previous quarter. So to that extent, as you start to see economy inch up above 6.5%, my broader thinking is that getting a 12% plus earnings growth on 2 consecutive years is not necessarily a very big feat. You know, even in a phase of 10 year of downturn that India saw, we saw 7-8% earnings growth. So 12% in a situation where you're going to see macro recover is a good enough possibility. So that's what we are essentially modeling. And if you see, we're not really building in re-rating for the price to earnings, and that's the reason we've got a very similar market returns target as well. The second question is more on downside. I guess I personally tend to play a lot when I take market calls on sentiment. Sentiment last year, mid of the last year, was exceptionally strong, and that's why I was very negative. Now, I actually think that sentiment is very negative at this juncture. Everybody is aware of the risks, the worries, currency, Trump, what could happen to macro side, will government actually accelerate capex and things like that. So I guess the way to look at that in terms of modeling is very simple. Last 10 year, Nifty probably bottom close to 17x in terms of 2 year forward PE. And even if we assume somewhere in the 7 to 8% sort of earnings growth, which is usually in bad times, somewhere around 22,000 or below is like more or less the hard bottom for Nifty. Now, that's not really far away.
Okay. Got it. Venu, one more quick point. You know, we're looking forward to some kind of support, both policy support as well as monetary support. The RBI, what are you all factoring in terms of their action? As you've mentioned in your note, this is the longest phase that you've gone without seeing a rate cut. I think close to around 700 days, which is even longer than 2004. So how many rate cuts are you all factoring in from the RBI?
Cumulatively, at the bare minimum, 50 basis point is a likely possibility that we see. Remember, the policy challenge is the fact that rupee is depreciating. And rupee, in our view, based on the broader metrics, is about 7 to 8% overvalued at this juncture based on where other currencies are, where US rates are and other things. Of course, that overvaluation could moderate over time when the market realizes that probably Trump's actions may not be as inflationary as you're already assuming today. So to that extent, the room for rate cuts could be higher than 50 basis point. But remember, it's not going to be a first half driven sudden cut in rates. I don't think RBI can manage the currency spiral that easily. So think of it as more as very minimum 50 basis points. And I do believe inflationary risks are much lower than what people believe.
Got that. Venu, one line in your report kind of stands out. And I think you're being tongue-in-cheek there, right? You say domestic flows have so far been immune to fundamentals, but it's the backstory. It's not exactly looking ahead, but I think you say that it seems they're investing for India 2,280, while low-quality IPOs continue getting attention.
Yeah.
It was from the heart, Prashant. It was an emotional gesture when I wrote that report. But that is the reality. I mean, let's be very practical about it. I look at India year to year, maximum a 3-year bucket. Who knows what's going to happen in 2040? And the reason I wrote that is because whenever I argue that SMIDs are in a bubble, I get sort of a pushback that India is going to be the largest economy in the world in 50 years. There's so much amazing growth story left. I think that's just storytelling. Nobody knows what's going to happen after 3 years. So this was primarily directed at that set of sort of commentary or investors or the feedback that I get.
But it is also true, while we keep that skepticism, we know, for people who can invest in India and are investors, I mean, they must believe, right? I mean, that's the first step. But
you don't need to believe in a 50, 75, Prashant, you don't really need to believe in a 50-year story. Honestly, we don't even know the shape of India 50 years from now. But the fundamental reality at this juncture is that the first stage when you actually see, let's say, 2-3 years of massive macro collapse, you're not going to be talking about, India great story at that point of time. Fortunately for us, we are in an early cycle. That's why I don't really see those risks playing out over the next 2 to 3 years, where you have to basically scurry and worry about, big collapse in the markets, right? So that's the only aspect I would say. But I don't think you should mask your near-term 1-year, 2-year views with 50-year stories.
No, absolutely, Venu. I'm glad you say that because there are analysts on the street who do write, of course, for the very, very, very long term. But I guess you, keep it more real. Just to wrap this up, so I'm just summarizing everything once again. Basically, you're saying it's the time to be cautiously optimistic. You're expecting a 12% index return this year, right? And what about earnings? What's your final number for FY25? And more importantly, FY26, what's the kind of earnings growth you're penciling in?
In a very simplistic way, think of, when I say earnings growth is typically I talk for Nifty 50 rather than for the overall NSE 500. Because NSE 500 will be, mid caps will have higher earnings growth than large caps, but NSE 50, Nifty 50 is somewhere in the 8 to 10% range for this year, 12 to 13%-ish for next year, another 12 to 13% for FY27. So over a 2-year period, from the next financial year, it is basically somewhere in the low to mid-teens. That's like the broad number that I'm working with.
All right. Okay, Venu, we'll leave it on that note. Optimism is good. And to get that from someone who's been very cautious in the market for the better part of, the second half of 24, a very, very interesting call. And we'll hold you to it, of course. Thanks very much. Have a great year and look forward to more conversations. But time to move on to our next management. In fact, the next one on the show is Uno Minda. That's the company in focus. To talk about the demand trends in 2025, we have with us Mr. Sunil Bohra, Group CFO at Uno Minda. Mr. Bohra, great to have you on. Thanks for joining in. So I think, that those are the conversations we've been having for the last couple of days as we're trying to gauge how many companies and corporates on ground are very realistically optimistic on the second half. The first half has been slower. You tell us, what are you seeing both in the domestic markets and in your global markets? Because even in the global markets, the automotive space has been fairly crimped in 2024, particularly in areas like Europe.
Yeah, so starting with the domestic market survey, so the first half, what we have seen, as you rightly mentioned, the auto market specifically domestically has been very good, led by the significant growth in two-wheelers, which has been into mid to high teens, and we do expect that momentum to continue in second half. And also the same way, the PV growth, what has been in H1, which has been a single digit, we expect that momentum to continue. But if you see the medium to long-term growth trajectory expected for the segment or for the sector, we are quite optimistic, and we have been significantly investing in building our capacities. As we know, we have been currently working on our 13 expansion projects, which is primarily mirroring the growth we do expect in the medium to long term. Coming to the Europe and the export market for us, though it is a very small revenue for us, it's around 12-13% of overall revenue, which comes from our exports plus the global operations. So specifically in, if you see in ASEAN, the business is actually very good. It's stable to positive. In Europe, yes, and Americas, the export has been little impacted because of some headwinds in terms of lower volumes, and we do expect that to continue maybe for some time now. We don't see any significant improvement in the near term.
Sunil, hi, good morning. Prashant this side, and Happy New Year to you and the UNO team. You know, before we come to the EV opportunity, Sunil, and what's happening there, because there are product launches, especially from players like Mahindra, etc., and of course on the two-wheeler side as well. Just give us a sense. I mean, you are, you know, you have added so much capacity, new manufacturing lines, new product categories that you enter into, and suddenly a new segment opens up in terms of growth for you. Just give us the latest in terms of the bigger product categories and how each of them are doing. Just the top 3-4 to give us a sense of, and of course your expectations for 25 for each of these.
Yeah. So specifically from the EV perspective, what you have touched base on, Prashant, we have been front runner in adding a lot of EV products, because a lot of our, not a lot, in fact, 95% of our existing businesses are not impacted by EV. They have they are basically agnostic to any type of energy vehicle runs on, be it seats, lamps, etc., etc. On top of it, we have been building our EV profile for starting with two-wheeler and three-wheeler very, very aggressively. And the kind of product profile we have, we are seeing significant traction. And if you have to convert that into numbers, even our last quarter numbers, our revenues from the EV segment specifically of the two-wheeler segment is almost like 14% or so, whereas the industry penetration was around 7%. That clearly shows the benefit or the upside we have been able to capture because of the transition from ICE to EV. And even in terms of PV, we have been building our product profile gradually. Though the volumes are very low, we have been working on to see that when the volumes pick up in next 2 to 3 years, we should be able to capture lion's share. We have tied up with a couple of technology partners like EVSE and for EVSE product from StarCharge and EXL with Innovance. We have already secured some of the business from our customers for the wall-mounted chargers or EVSE, and we are in process of putting capex to deliver those volumes in next year or so. And from the other product, which is the EXL, etc., which is a high kit value product, almost 1.5 to 2 lakh rupees potential kit value. There we are still working on our project schedule and project plan. And in another 2 to 3 years, that project also should be up and running. So that's the broad perspective on the newer products which we are adding. On top of it, if you remember, we have also added products like sunroof, which again is a high kit value product. That is also in next 18 to 24 months, we'll see a start of production, because it's linked to the business we have secured with the launch of the new model of the customer.
Sure. That's pretty interesting, Mr. Bora. And just to follow up on the whole EV part of it, as you add these new products and as you expand your EV offerings, even on the four-wheeler side, how much of your business will have EV exposure? I mean, just trying to understand across two-wheelers, four-wheelers, across the board. And typically when you sort of offer more EV products, How do they compare in terms of margins? I'm not sure. I mean, whether it's switches, whether it's, any of the other components. Do they fetch you better value? Because whether it is, local PV manufacturers or even international, I mean, EV is definitely, it's here to stay.
Well, definitely, it's little early to comment on margins on EV, Surabhi, because we all know that even our customers are trying to penetrate the markets with the attractive pricing. So it's little early to expect that we will be able to make a better margin on EV products. But as volumes ramp up, we do expect our margins overall to be in line with the business margins, because today a lot of the EV businesses, we have set up some capacities. They are not 100% utilized. They are gradually sort of expanding. And as we move forward, we do expect that operating leverage factor to come into play. But what we have to consider is that all the existing product, what you mentioned, like switches, lamps, seats, they continue to be in EV as we have in ICE.
And ICE, yes, both.
Yeah.
Absolutely. Plus you have the new products which are coming in specifically for EV. Interesting times, and I think once third quarter numbers are out, that's when we'll discuss further financials and projections for the full year and for the next year. But for now, thank you very much, and good luck for 2025. That's Uno Minda. On that note, we'll have to take a very quick break. Come back on the other side. We'll do a quick check on the markets, and of course, we have the management of Nuvoco Vistas joining in. They're looking at a cement acquisition. More on this in just a bit.
Welcome back. Keep an eye out on a few stocks. Kalyan Jewellers is calling for attention. From yesterday's high, it's down close to around 100 rupees, and the volumes are very, very large. So we'll have to get further clarity on this, because otherwise the numbers didn't look too bad. But Kalyan Jewellers is the one that's under immense pressure, down close to around 5.5% as we speak. Let's focus on the cement space, though. Nuvoco Vistas, they have won the bid to acquire Vadraj Cement in the insolvency resolution process. To help us out with how things are shaping up, few details on this particular acquisition and the way ahead, we're joined by Mr. Jaikumar Krishnaswamy, the Managing Director at Nuvoco Vistas Corporation. Well, thanks a lot, sir, for joining in. Good speaking to you, and it's been a while since you joined in. So let's get straight to the point, Mr. Jaikumar. What is the tentative deal size of this particular acquisition? And also, you'll have to incur some capex since this plant was shut. How much is that?
Okay, Vadraj Cement is two plants in Gujarat. It has got an integrated clinker unit in Kutch for 3.5 million tons of clinker. And it has got a grinding unit in Surat with 3 VRMs. So the installed capacity of the grinding unit is 6 million tons and the clinker unit is 3.5 million tons. So this came through the IBC process, and we bidded for it sometime in the month of May and June. And the bidding process happened during the Q3, and finally yesterday the letter of intent was received. So the deal costed us 1,800 crores for the assets, and on top of it, we have done a complete due diligence of the sites and have a technical estimate of how much it will cost to rebuild both the sites. Both of them have got well-established equipment, just that these equipments have not been in service for the last 4 years. So it will cost us approximately 1,000 to 1,200 crores. Overall, we are looking at $60 to $65 per ton of cement from this deal.
Okay, all right. But how are you going to fund this particular deal, since your debt is in excess of around 4,000 crores odd as of last count?
So in all our quarterly earnings call, I have been mentioning that around FY23, Q25, Q4 or Q1 FY26, we will start our next phase of expansion when the debt levels of the company are thereabouts 3,500 to 4,000 crores. And as we progress this year and end this year, we will be around that kind of debt levels for the company. So how do we fund this deal going forward? We still have got 6 to 9 months when the NCLT approval takes place. We're currently under the process of working out a funding mechanism through which we will fund this deal. One of the things we are very clear is we will have to ensure that the leverage on the Nuvoco balance sheet is appropriate, and we will meet all the covenant conditions when the deal is consummated.
Mr. Jaikumar, I'll have to push you a little bit more. Give us a breakup with regard to the funding, since you're already going to be taking on close to 1,800 crores of debt from this acquisition. So give us a breakup on the funding.
Currently, we have a
business which delivers close to about 19-20 million tons, and the current pricing and profitability levels, Q4 and then beyond looks when the overall price stability happens and the overall profitability of the business improves. And our confidence level says that we would have adequate internal accruals to fund the capex program of this deal.
Okay, all right. So we'll have to wait by to see how much of it will be internal accruals. But let's get a basic point out of the way. Your current debt is around 4.3 thousand crores, very, very roughly. Given that you're going to be taking on some debt, what will the peak net debt level look like for the company?
No, I can answer this question simply by the fact that in the last 2 to 3 years, quarter on quarter, our debt levels have been pared down when compared to the previous year's number. And as I stand at the end of quarter 3 and beginning of quarter 4, I'm looking at a number which I have made informed during the earnings call. So at this kind of numbers, it's very difficult for me to kind of project a peak level debt at this point of time, because the peak level debt is a function of the profitability of the industry as well as the overall demand scenario. But sitting here, I can, looking at the last 6 to 8 weeks of how the demand has progressed and how the pricing is shaped up in the industry, I'm pretty confident that as we traverse Q4 and well into FY26, the overall profitability of our business will improve and we'll have adequate internal accruals to fund this deal.
Profitability will improve. You know, the reason I'm asking about the debt is because the street would like you to keep your leverage under check. But let's focus on the equity side of things. Is it possible that you raise some equity to fund this deal?
I won't be able to comment on the instrument of funding in this deal, but we still have 6 months. We are cognizant of the fact that we have to ensure that the balance sheet of Nuvoco is steady and we meet all the covenant conditions. And within the framework of all the covenant conditions, we will be doing the fundraise for this deal.
Okay, so the funding is still a little bit sketchy, but let's focus on what could the synergy benefits be. Since you already have exposure to the region, you must be having some kind of synergy benefits that you're factoring in. Could you tell us what could that quantum be in that particular region, that's north and west?
Vadraj comes us with 2 distinct advantages. One of the principal advantage for Vadraj exploration was to get into an area where we are not present, which is namely Gujarat, Western Maharashtra and Western MP. So this gives us access to new markets. So, and makes this company from largely an east-centric company to a east, north and west-centric company, which will take us our capacity from 19 million tons in east, another 6 million tons in north. Overall, we've got 25 million tons of capacity right now. Another 6 million tons in west will take us to 31 million tons. So the primary objective of the deal was to fund the growth engine of the company going forward. However, with our current sourcing model of Gujarat as well as Northwest Maharashtra and Western MP, this markets are serviced from a Chittorgarh plant. And then once we have this Vadraj asset with clinker in Kutch and grinding unit in Surat, we are looking at synergy benefits in logistics as well as the inbound freight, whereas we targeting to unlock close to about 100 to 150 rupees per ton in the overall cost base of the company servicing these markets.
Okay, 100 to 150 rupees of cost synergies in north and west region. Got that. Let's get an industry-wide perspective for you. Do you believe that cement prices have bottomed out from the multi-year lows, and have you taken some price increases in the recent past?
If we had this conversation probably 2 months ago, I would have presented a gloom and doom scenario with prices really going down, and certainly bottomed out in October and November. But I think come December, we've had price increases. We took price increases in east as well as in north markets, and albeit not very big price increase, but we have indeed taken price increase in all the key markets in east as well as in north. And this number should hold good in January and beyond. And with this kind of improved numbers, it will show up the overall performance of the entire industry and certainly for Nuvoco. I'm only targeting with better mix of premiumization and geo mix and focusing on key markets, we can unlock a little bit more value for the organization. Overall pricing, as you asked, is my view is bottomed out this fiscal. And from now on, I think certainly pricing should improve and overall improvement in the results of the entire industry should happen going forward.
Got that, Mr. Jaikumar, but we need to ask you this final question before we let you go. There was some part of in the market that was expecting a bit of a sellout from Nuvoco's promoters. Could you clarify and clear the air on this point? Is Nuvoco on the block?
I think, how could I answer a question like that? The fact that we have demonstrated that we have an appetite for growth and we have cemented our leadership position in the market, and we have now continued to be a fifth largest cement company, moving our capacity from 19 to 25 to 31. It speaks very high of our commitment to stay in this industry and grow the market.
Well, we appreciate you joining in, Mr. Jaikumar, and clearing the air on that front. So since you're focusing on growth and expansion, you're clarifying that Nuvoco is not on the block. Congratulations on this Bazaar cement acquisition, and we'll hold you to some of those numbers. But the other big takeaway for the industry perspective is he believes that pricing has bottomed out and things should look up from here on.
Okay, all right. That's an interesting chat with the Nuvoco management after a while. Let's just look at the Nifty sort of as well and take a look at what's happening. I think there has been some recovery from the day's low, which is set in. The Nifty is flattish, but I think the Nifty Bank is the one which has come up quite nicely. So 70 points lower on the Nifty. The Nifty Bank, which did better yesterday as well, has recovered. Yes, so that is doing better. It's in the flattish kind of zone after starting down. So from the lows, it's picked up. So 50,150, banks doing better than the Nifty. And maybe just sort of round this up with the look at the mid and the small cap indices as well. And then we'll
cap
sort
down
of...
1.3. The decline is far more pronounced in that part of the market.
Full reversal of the 1% pop that we saw on the mid cap index yesterday. And small caps also down about 1 1/3% or so. Well, we're talking about GDP numbers at about 6.4%, slightly slower growth, etc. It's important to see the implications of that and whether something is showing up in sectors like real estate, right? So many linkages from that one sector and so important for the overall economy and, of course, markets as well. A recent Knight Frank report suggests that residential sales were at a 12-year high in 2024. They're also expecting strong fundamentals poised to sustain this year. We have Ghulam Zia, Senior Executive Director at Knight Frank India with us. Ghulam, we're chatting after a while. Good morning, Prashant this side. Thank you for your time. Happy New Year. So good to hear that you're...
And Happy New Year to you and your viewers.
Thank you. Thank you very much. Good to hear you're expecting strength to sustain. But is there any way to tell, Ghulam? Are there any indications or suddenly, how does one tell? So far, so good. Sales are sustaining, there is strength, etc. For example, I'll tell you, I was talking to somebody in the hotel industry and they were saying that I was asking them how the season has been. And it was interesting, the answer stood out. He said, well, it's been kind of sluggish this particular holiday season. And he said, well, one of the reasons could be because the stock market has been slightly sluggish lately over the last 5-6 months or so. For real estate, I think the linkage is there, although there's no way to tell how much. Just your sense, top level, high level thoughts, and then we'll get down to it in terms of specific things. Go on.
Well, you're absolutely right. Most of the monies that we were watching coming into real estate were on the gains that you made on stock exchange. And many of those, especially the mid to high end and the luxury, uber luxury segment was thriving because you had so many IPOs, people pulled money out of stock exchange and so on and so forth and all of that. Most of it was coming because you're buying, apartments of 100 crore plus worth, maybe in a lot of them in Mumbai, but quite a few in Delhi. So when you're talking about some sluggishness, I'm sure it will reflect on real estate as well. But so far, it is not showing any signal of any slowdown because the numbers are very, very strong in the whole 2024.
And more importantly, looking ahead as well, it is looking pretty good, right?
Indeed. Because when we are looking at...
And the big markets like NCR, etc. as well? I mean, the NCR, Mumbai, etc. looking...
Well, NCR of all the top 7-8 markets, NCR is the only market where we have seen some slowdown, about 4 to 5% less volumes compared to 2023. That's the only market where we're expecting the number of sales to shoot up beyond 60,000, but it is the only one which has remained at 57 odd thousand, slightly lesser, but the signals are emerging straight away from Delhi. And I recall about 15 or 18 odd years back, it all started from Delhi. So I shudder to think that Delhi is giving some signals, but the other cities are yet not following because we continue to see growth in numbers of transactions.
Ghulam, hi. You know, we discussed this with Mr. Ashok Tyagi in the last week of 2024. I remember asking him exactly this. Is there too much of over-exuberance in the whole sold in 2 hours, sold in 1 day, you know, whatever's been happening for a lot of, developers, including DLF. And he actually at that point in time told us that they have started taking some precautionary steps. They've increased the down payment, for instance, to ensure that there is a genuine demand, not the flipping. He says he's still not seeing the sign of the so-called flipping, which was the peak of the last cycle, where you buy and try and flip in 6 months. He says that's not visible just yet. But anyway, season's greetings to you and a very happy new year. So we need to watch for Delhi. That's takeaway number 1, Delhi NCR. But let's talk about the other markets as well. Let's talk about Mumbai. What do you see ahead here? Where are we in the cycle? Is a lot of this genuine, buyer demand? How much is investor demand? And where is Mumbai in the realty cycle? What do you see in terms of transactions, volumes and pricing in 2025?
When we average out, when we're looking at the macro picture, a lot of things are hidden in it, because when I'm talking about almost 100,000 number of units sold in primary market, which is when the developers are selling, almost about 98,000 apartments were sold in 2024. But then if you dig deeper, and this is the first time I haven't seen any other data provider talking about it, we have absolutely analyzed the upper end, because for last 2-3 years, everybody is talking about luxury, luxury, luxury. We tried to find out exactly what does it mean. So when we break it into various sectors, 5 to 10 crores, 10 to 20, 20 to 50 and 50 and plus, here a few signals are emerging. When it is absolute uber luxury or ultra premium segment, as we call it, 50 crore plus, in that segment, there is hardly any stress. The apartments are selling like hotcakes. And also the inventory, because ultimately when you look at the demand and supply scenario, the velocity of sales, whatever inventory existing in that category, which is 50 plus crores, will be actually exhausted within 4 to 5 quarters. But when you look at the very next segment, which is 20 to 50 crore segment, here we can clearly see some stress building up, especially in Mumbai, because this market is very exclusive, Mumbai and Delhi alone. But in Mumbai, we see a lot of signals emerging, because the inventories have come in a lot in that segment. And we are looking at almost about 5.5 years to exhaust that inventory. And that is a sign of worry. That is a sign of worry, because in that segment, the velocity of, or rather the launches have been a lot. And that's where the problem is. Rest of all the other sectors are doing absolutely fine. Of course, the absolute lower end of the market, the affordable housing, hardly any inventories coming in, and hence it is suffering. But the key takeaway is that the 20 to 50 crore, a lot of inventories have come in last year.
That's a big headline, that in the city of Mumbai, inventory which is in the 20 CR to 50 CR bucket, there's 5 years of inventory right now in the market, and we need to see if it's exhausted that well. What about the buckets below that? What about, the definition of affordable is very different for Mumbai, but if you talk about, and let's also expand this to other markets like Bengaluru, etc. If you talk about the 1 CR to 10 CR sort of broad range, which is, let's call it affluent housing, what's happening here with respect to inventory? Do you still expect the same level of absorption?
Well, I can generalize it, except for this segment in Mumbai. Everywhere else, I'm looking at 5 to 7 or 8 maximum quarters of inventory lying in the market, which means within 2 years, you will sell whatever wares you have, provided you don't launch any further. So which is where we are right now. Every market, except for this one segment in Mumbai, is in that 7 to 8 quarters of an inventory availability, and which is nothing to worry about, including Bengaluru. Even in Bengaluru, when we look at the 10 to 15 crore or 20 crore category, even there, it is not more than 6 quarters of inventory lying, which means even that is a very healthy market. In all of this, one market which is standing out is Hyderabad. Hyderabad is one market which is actually in price points as well as the ticket sizes are actually almost about Bengaluru or even beating in a few cases. But even there, the inventory in the mid to upper end and the luxury segment is absolutely in control, which means not more than 8 quarters of inventory lying in the market. So as I said, once again, except for that one category in Mumbai, Everything else is like, at least now, looking absolutely all right.
Ghulam, now let's do some stock picking with you. I say replace the word stock with micro market picking with you. Give us some ideas. I mean, if people have some real estate investment money lying around, I mean, what are the micro markets one should look at specifically?
Look, I'm very, very clear on this. For last so many years, almost about 12, 15 years, I'm talking about it. Don't punt on real estate. The real estate growth at 7-8% per annum kind of improvement of price appreciation is not the market when you compare with other investment options. So whatever sales we are talking about, even in the upper end, you're not expecting people to keep flipping. And I think you just about short while back, you spoke about it. Flipping is not happening. Perhaps the people are much wiser today. They know that you cannot expect the prices to double up in 5 years. Only then. I always tell people, if you're confident that whatever you're buying will give you 100% improvement in next 5 years, you should buy.
I get it, Ghulam, I get it.
But
there are lots of people who will not miss the money, even if they want to put.
They want to own a hard asset, for some of them.
For investment or for whatever, right? I mean, they want to park money. So for that category, and there is a category, there is that cohort of people, because so much money has been made through markets, through stocks, and here also the rate of growth is kind of start to slow down a little bit. Can't go like this forever. So naturally, you start to look at other places. So for that segment, Ghulam, what are the best micro markets in that sense?
In fact, I'll only talk about 2 points. If you want to invest in land, buy land. And there are a lot of developers who are coming up with these, large townships where they're selling land, because land is where you have maximum potential of an improvement. But that said, since we're talking about the luxury and uber luxury market doing so well, ultra luxury segment people are buying, here it comes to investment of passion. You're buying these apartments because you want to show the society that you have arrived. And that's what it is. When you're talking about the upper end, all these transactions are straight away hinting at that. Nobody is expecting the prices to double up. Like, for example, if you're buying an apartment for 50 crore or 75 crore, you're not expecting it to grow to 200 crore in times to come. It's only because you want this apartment and you will be staying in it.
But land where, Ghulam? Sorry to press you. Land where?
There are a lot of these locations in the remote areas of these metropolitan regions of Mumbai, Delhi, Bangalore, etc., which are improving by way of infrastructure connectivity. So you have a lot of these infrastructure pieces falling in place even in Mumbai. So when we are talking about, say, Vadhavan, the place where you are going to have a new port coming up altogether, absolute greenfield area, nobody has ever spoken about it. Otherwise, you have areas towards Bhiwandi or Panvel, even Panvel to Alibag are the locations where a lot of these developments are coming up because of improved infrastructure. Can you imagine by road traveling from Nariman Point to Alibag will not take you more than an hour in times to come with Atal Setu and a last mile also connectivity happening in a year and a half or two. So a lot of these infrastructure connectivities are going to improve your land connects around the cities, and that's where you have to look at, because that's where actually the improvement or appreciation will be the highest.
Okay, all right. Very, very interesting. Got it. Ghulam, you know what? I will thank you because I think Prashant is just walking out to figure out his checkbook and, looking at his investments. I think the next couple of days he'll be making that long-term transaction. But no, jokes aside, thank you very much for joining in and educating us on what's happening. So the good news is that there's no red signal just yet, but we need to watch out for the category,
I'll tell you
the almost uber luxury category where there's a lot of inventory in Mumbai, 5 years of inventory. Got that. Thank you very much, Ghulam.
And the other point, what he said, right? Delhi NCR.
Yeah.
That is a market which...
Typically, it signals that there's problem coming.
You go a little too aggressive. We've all seen it, right? 2007, 2008. So, and I think Ghulam used that phrase, I shudder to think if we see a repeat of that, and that kind of becomes... but it's a very important sector for the economy, and it's crucial that the momentum in the sector stays strong. So far, it looks that way. We'll take a quick commercial break here. Manisha Gupta will focus on the commodity space when we return. Stay tuned. All right, welcome back. We've got the market down about 30 points. Banks are doing a little better. Mitesh is with us with what he'd like you to do. Mitesh, good morning. What would the advice be now?
See, I think on the index, it's still a choppy but non-rational kind of a movement. But what is interesting me is the stock of Reliance. I think after a long time, Reliance has come on the buy radar. So recommend to buy here with the stop at 1242 for targets of around 1300 plus. And, that one, could in turn, obviously, it will affect the performance of the Nifty as well. So I think that's one stock to watch out for. And on the selling side is Apollo Tires with a stop at about 495 for targets of 470.
Okay, all right. Mitesh, thanks very much. We'll watch out for these stocks. Reliance, of course, is doing really well on the back of a couple of brokerage upgrades today. But let's shift the focus now to the commodity markets. We have Manisha with us. Manisha, what's the latest? What are you looking at?
Well, I'm looking at the crude oil prices because this is one sector that has continued to gain into the markets there. If you look at the prices itself, we are looking at crude prices trading at 3-month highs. Well, last year, the prices declined 3%. It was a second yearly decline for the crude oil prices. But when you look at this year and on a week-on-week basis, we've gained up by 2% for crude. And for this year, until now, we have already up by nearly 4% for the prices. Well, there are a few things that seem to be supporting crude oil prices at these current levels. One, it has underperformed, so there is some money allocation coming. Second, the U.S. crude inventories have continued to decline for a fourth straight week. So you are looking at tight global supplies, and that really seems to be supporting the markets. Well, escalating Western tensions that you are looking at on Russia and Iran is also yet another thing that is keeping prices higher. Important also is to watch on what Saudi Arabia really seems to be doing for its Asian consumers and consumers across the world as well. So Saudi Arabia has raised prices for Asia for the first time in 3 months, and this would start from the month of Feb. For the month of January, when you look at the prices, we are at the lowest we saw in last 4 years. But that really seems to be changing at this point in time. And the kind of price rise that we are seeing for the month of Feb is almost $1.50 barrel higher than what the regional premiums really seems to be going. So that tells you that supplies from the conventional areas is not coming. The demand for the Asian markets is continuing to be on the higher side, and that clearly seems supportive. The other thing also is that the latest data that has come in from OPEC shows that the December output from OPEC has declined by nearly 120,000 barrels per day. So if you look at the total number, that stands at just about 27 million barrels per day. And you are looking at maintenance activity in UAE. There also is production decline coming in from countries like Iran and Kuwait. And then Russia production also continues to decline. The December data shows that Russian output was at around 8.97 million barrels per day. So whether it is about inventories, demand, cold weather, it also has to do with sanction expectations. All of that seems to be supporting crude prices. Going forward, it is going to be about Fed meeting minutes that get released today. And then you have U.S. non-farm payroll data that comes in on Friday to give you further cues.
All right, Manisha, thank you very much for that. So that's commodities in focus. Let's revisit some of those standout stocks as far as the brokerage reports are concerned. Nimesh, of course, is with us with exactly that. Nimesh, good morning again.
Hi, Mani Prashant. So, today I had highlighted the standard was on cement. CLS has turned constructive on the sector, and they believe that the earnings visibility is improving, which means there are opportunities arising for buying. Today they've upgraded Dalmia to outperform from hold. They've raised the target price there to 2110. And they've upgraded ACC from underperform to outperform, so technically a double upgrade. And they've raised the target price there to 2580. Now, the three big themes for 2025 for the cement sector: one, capacity demand recovery; two, consolidation and capacity expansion; and three, profitability on back of low base and cost savings. In terms of individual stocks, they continue to be overweight on Ambuja Cement. On Dalmia, while they've upgraded the stock, they feel that the lack of medium-term earnings visibility is pretty much in the price, and hence there was an upgrade there. On ACC, while they have upgraded the stock, double upgrade the stock, they continue to prefer Ambuja in the Adani space. They like Ultratech Cement, but they believe that the risk reward is quite balanced. The only underperform rating they have is on Ramco, and there they are awaiting for more clarity in terms of growth emerging. So that's the preference list. But today, a big upgrade on Dalmia Cement to outperform, and an upgrade on ACC to outperform with the target price raised to 2580.
Okay, all right, got that, Nimesh. Thank you very much for those updates. We'll watch out for those cement stocks. Let's talk about some more brokerage notes that are quite interesting. Rarely is it that you see a brokerage come out with a negative view on renewable energy plays, but that's exactly what I think Kotak has done with Vari and Premier Energies. Vivek, tell us more.
Well, the negative view, like you mentioned, is largely based on the valuation. Overall, they're quite positive as far as the solar value chain is concerned. What they're saying is that the India's solar sector is primed for growth They are anticipating 18% CAGR in utility-scale solar capacity additions till FY30. Along with that, Indian solar companies are well positioned for strong growth in domestic as well as US markets. This is aided by both trade as well as non-trade barriers. What is it that they find will be the key earnings drivers for two companies that they have initiated coverage on, the Premier Energies as well as Waaree? What they're saying India capacity addition as well as backward integration aids them, expansion into US cell manufacturing, higher capacity utilization, and they are also anticipating margins for both of these companies to peak in FY27, given the fact that they anticipate competitive intensity could start impacting their margins from FY28. So as far as Premier Energies are concerned, initiating coverage, sell rating, fair value of close to 770. So they see 40% downside, to yesterday's close. And when it comes to Waaree, again, they have a sell rating over here. They see 7% downside to yesterday's rating. Remember, Waaree is the largest solar cell manufacturer and Premier is the second largest. So overall positive, but valuation is something that at this point of time, they don't find palatable.
All right, Vivek, thank you very much for that. We'll take a quick commercial break here. Our segment, it's the economy with Lata on the other side. Lata will be speaking with Sakshi Gupta of HDFC Bank and Pranjul Bhandari of HSBC, and they discuss the positives and negatives of the 6.4% GDP estimate for this year. Stay tuned, that's coming up.